Welcome and thank you for joining today's webinar on ACA enrollment declines, the implications and options for state and federal policymakers. My name is Jen Colomonico and I'm happy to be moderating today's session with some esteemed colleagues whom I will introduce in a moment. First, I just want to let folks know, yes, we are in fact recording this, and yes, you will receive the slides. Always our most popular question, and for sure we will be sending those in a follow-up email with the recording. We also would ask you, as you listen throughout the webinar, to submit questions in the Q&A box. We will allot time at the end to answer those questions. And if we don't get to all the questions, we will certainly follow up with them after the fact. So please go ahead and post them as they occur to you. So let me just take a moment and introduce each of our panelists, our phenomenal ACA team here at HMA. Michael Cohen is a principal at Wakely with deep public sector and federal policy expertise, including nearly 8 years at CMS and the White House, advising clients on ACA markets, exchange policy, and healthcare econometric analyses. Zach Sherman is a managing director at HMA and an ACA and health insurance marketplace leader, recognized for launching and transforming state-based marketplaces, driving enrollment growth, and delivering operational and policy results through collaborative leadership across government and industry stakeholders. Zach was the marketplace director for 2 different states. And Liz Rowe is a principal at Levitt Partners and leads our federal policy and government affairs practice. She is a nationally recognized healthcare policy leader, former chief counsel for the Senate Help Committee, and the health policy director for the Senate Budget Committee, with extensive experience shaping federal health policy, Affordable Care Act reforms, insurance market stabilization, and bipartisan healthcare strategy. So with that, you are in good hands for today's conversation, and I will go ahead and turn it over to Michael to get us started.
Thank you so much, Jennifer. It's not hyperbolic to say this has been one of the more tumultuous, uncertain, and kind of changeful years in the ACA since its launch back in 2014. And more changes are coming. And so for this webinar, we're kind of hoping to walk you through what are some early data that we're seeing about the 2026 experience and what context that includes, what the very, very recently final notice of benefit and payment parameters included and how that might affect things. This is the regulation that was finalized on Friday. And finally, we'll turn towards what other changes may be coming down the pike from a federal perspective. And we'll make sure we reserve some time for some Q&A. So without further ado, we'll get going. And so it's probably in that vein worth taking a step back and remembering all that has occurred over the prior 12 months. This include the expiration of the enhanced premium tax credits, which resulted in very different eligibility and premium subsidies amount. There were also regulatory and statutory changes in the form of the program integrity rule, as well as the reconciliation bill, OB3. And all of these changes coupled with kind of underlying increase in medical trend meant that basically every sector, cohort, functionally almost every individual in the individual market had a change or a dramatic increase in their premium. Subsidized enrollees on average had increases of up to 100%, actually in some certain circumstances more, and unsubsidized enrollees could see premium increases, at least on a national average basis, in excess of 20%. And so all of these changes brought the question of, well, what does this mean for the market and for its composition? One of the difficulties in answering that question is that as part of the statute of the ACA, subsidized enrollees have a grace period, so they can have up to 90 days in certain circumstances before they're disenrolled. And so getting a handle on what the enrollment picture is kind of evolving aspect, certainly in the initial few months of the year. Next slide. And so with that said, our very kind of first look as to what was going on in the market was through the plan selection data. What did people sign up for? And that initial data didn't show huge changes, at least in terms of people signing up for coverage. There was only a 5% drop. The kind of the canary in the coal mine was that new consumers decreased fairly significantly. There was also a lot of buying down by enrollees that were actively choosing their plan, and buying down, what that means is they were choosing plans that had cheaper premiums. In many cases, we're talking about going from a silver premium down to a bronze premium. Next slide. As all things go for the individual market, there was a lot of variation, though. What one aspect was that states that comprised FFE expansion states that HHS operates, but also that they had expanded their Medicaid program, saw some of the largest decreases available, but there was a lot of variation state to state. Zach, you want to provide a little bit of color commentary on that?
Yeah, certainly. Thanks, Michael. I think, notably you mentioned the split between expansion and non-expansion states, and one kind of surprise to highlight, I think, is that the non-expansion states on the FFE outperformed pretty considerably the expansion states, and with the enhanced subsidies going away, the kind of the biggest net premium hit consumers would feel is at the lowest income levels, and that's where we saw the most enrollment growth in the non-expansion states. So just notable that that trend is different than I certainly expected. Another thing to highlight, I think, is that the kind of, you mentioned the state level data varies considerably. I think we saw that most, or notably, maybe most notably with state-based exchange states. The highest performing state was New Mexico, who took control of their destiny and fully funded the expiring subsidies with state premium assistance. And they achieved a 14% enrollment growth year over year from 2025. On the other end of it is Georgia, who is the only non-expansion state who also operationally has heavy emphasis on enhanced direct enrollment assistance. They saw the largest year-over-year decrease, also 4% going, 14% going the other way, and states in between had different results. But I think kind of a consistent trend is where states invested in affordability. Their enrollment losses were lower, or in some cases, they saw enrollment growth.
Thanks, Zach. Next slide. And so that kind of brings us to the limitations of these initial plan selections, because it doesn't give insight necessarily as to if these enrollees paid their first premium. And as you can see, enrollees that weren't actively choosing a plan, that aren't new to the marketplace, that they were just auto-enrolled from their plan last year to this one, saw huge increases in net premium. And so it begs the question, are they going to pay their first premium? Are they going to stay in the market? And to answer that question, next slide. We undertook for the first time ever a data collection to try to get a handle on if people were paying their first premiums. And to do this, we relied on data from our Wakely's National Risk Adjustment Reporting project. This is data both on and off exchange. It incorporates 75 issuers in 30 states. That's about 80% of the compliant market as of 2025. And we collected data both on what their enrollment was last year and in 2025, what their enrollment was in 2026, and trying to get a handle on did those enrollees in 2026 kind of pay their first premium. It was really important to get this information out to issuers so that they could help with their pricing. And so we collected data kind of as of February 1st. And so that has its own limitations, as we'll kind of talk through in a little bit, but it gives good insight across large parts of the individual market, who is and who is not paying premiums. Next slide. And probably the key takeaway figure is that only about 86% of enrollees were paying their first premium. There was considerable variation state to state and between types of states. The payment rate was a little bit higher in SBEs than in others, as Zach said, kind of furthering that theme. But even within types of states, there was huge amounts of variation. For example, even among FFE Medicaid expansion states, there was maybe a 30 percentage point difference between some of the higher performing states and lower performing states. When you roll up those people that were not signing up for coverage from 25 to 26, those people that signed up from coverage in 26 and that weren't paying their first premium, and then kind of our estimates of what net attrition could look like for the remainder of the year. You know, how many people may keep their coverage, who may pay their first premium, but maybe they're not their second or their third, as well as what changes we could expect from special enrollment period and enrollments. We made an estimate that we're expecting the overall market, both on and off exchange, to shrink between 17 and 26%. Since we've completed these estimates, there's been a number of data released from state-based marketplaces, from various reporting. I know most recently, like KFF released some estimates, and everything seems to be, as of today, lining up with this estimate. Obviously, there's still a lot more of the year to go, and there's still a lot of uncertainty. But you know, we've been asked a few times since we initially released these estimates, how are things lining up? And from the data we have at the moment, seem to be still on track. The next question is, what does that mean for morbidity? How much sicker is the risk pool as a result of these enrollment losses? And it's still a little early to ascertain this. Issuers are still kind of compiling their initial claims information, but based on information of who kind of stayed in the market from 25 to 26, as well as kind of historical patterns of what new enrollees to an issuer look like, we estimated a morbidity increase of about 3% to 6.5%. It's something that we're going to be tracking. We'll for our WINRA participants, as well as we'll be doing another kind of national study that we're planning on releasing in a couple months. We'll have better and more accurate information on how morbidity is changing. But again, this seems to align with issuer sentiments and actually issuer pricing. Next slide. One thing that's probably worth mentioning is how much metal level distribution did change. As I mentioned, there was a great deal of buy down happening. A lot of people shifting out of silver into lower premium plans. And in many cases, this means going from a silver to a bronze plan. In states that the silver premium is higher than gold, this also meant shifting out of silver into gold. And so this is actually a new, more unique distribution that we haven't quite seen before. It's different than it was during the EPTC world. It's in fact actually different than the pre-EPTC world. And so it's just a little bit of a newfound distribution that issuers, I think, are still kind of grappling with. What are the implications of, and to what extent is this status quo, or we should be expecting further changes in future years. Next slide. And in terms of what does that mean in a big picture, one is just reinforcing how much uncertainty there is, that both between states, within issuers, that there's considerable variation. The range of enrollment loss, as we said, is a national estimate. For different types of states. For a state, that range could be very, very different. And so issuers are kind of assailing that, using that information currently And they're using that information to both make estimates about what their 2027 pricing is, right? Which is obviously slightly based on what their experience is that they're just trying to get a handle on individually, but also they have to consider what the market around them is doing. Since as part of the ACA rating rules, right, you have to take into account the entire market via risk adjustment, via single risk pool requirements. And so like the issuers are taking that information to think not just about their 2027 pricing, which is starting to roll in as we speak over about the next month, but also kind of thinking about what that means for their actual 2026 accruals. What's their financial status? Again, because of the large changes, they have to think about how risk adjustment transfers would be different. So with that said, we're about to turn towards the future, but I think we'll take a quick pause and see if there are any questions.
Yeah, there's a couple great questions that I think would be helpful to clarify. First of all, there was just one clarifying question about Georgia. If you could just repeat why Georgia saw such a high disenrollment. Do we know yet?
I don't think we know definitively. The couple things that I suggested are Georgia is different from all other state-based exchanges in that it is a non-expansion state. So they had a higher percentage of consumers enrolled in the 100 to 138% of federal poverty range, which was pretty significantly impacted by the expiring subsidies. And the other notable difference is that they're the only state-based exchange that is most aggressively embraced enhanced direct enrollment pathways. And it's not necessarily the reason why the enrollment is down. It's just a notable difference in their operational approach to eligibility and enrollment.
Okay, state-based exchange, but not expansion state. Somebody posted the question and I had the same one, which is just the kind of somewhat illogical finding that Medicaid expansion states saw more decline in enrollment. Do we have a sense of why that might be?
Yeah, we don't know for certain. One good explanation that we've seen in the data is that a group that did not decline as much as expected was that 100 to kind of 150, 100 to 138 population. They're much more even after the ending of enhanced subsidies. They're the most heavily subsidized group, which means if they still had the opportunity to buy down to bronze or to lower silver and maintain a $0 premium as a whole, the market still has a higher percentage of people with $0 premiums today than they did in the pre-EPTC world. And so non-Medicaid expansion states have a larger proportion of that FPL. And so since they're more heavily subsidized, they were still able to access $0 premiums. It was probably propping up some of the enrollment, reducing the enrollment losses.
Got it. Question about, does failure to pay the first month's premium result in automatic disenrollment? How many failures to pay before you actually lose coverage, or could it be that they catch up and can still retain?
Yeah, so it depends on if they're subsidized or unsubsidized. Unsubsidized enrollee, it's a function of state law. Typically, it's about 30 days. And so after that period, they would be disenrolled. Subsidized enrollees have 90 days to basically what's called a grace period. And so if they don't pay their premium the first month, the second month, and the third month, then they would be disenrolled. And so the data we have is maybe 1 month out of that grace period, right? At most. And so it's definitely possible that some of those enrollees that did not pay their first premiums could come back and pay their premiums and therefore maintain coverage, right? It becomes a little bit harder, right? If you have 2 months or 3 months of premiums to pay than 1 month.
Adds up, yeah.
Right. Those uncertainties were built into our estimates, but it's definitely worth acknowledging that, like, this is one of the reasons why it takes so long to get a good handle on what enrollment patterns are going to be, because what happens is after those 90 days, people are retroactively terminated back to that first month. And so you can see a lot of movement in enrollment, especially in that kind of early first few months of the year. Zach, anything to add from your vantage point?
No, I think that covers all of the very technical details of grace periods for these different populations. I think maybe I'd just add that it creates a lag and a drag in the data. The full implication of non-payment, particularly in the beginning of the year, takes some time for us to fully realize how many people did not pay.
And then just the changes in metal levels, I thought was interesting. There's a question about how much buy down was there among unsubsidized enrollees. And I was curious, actually, if we could go back to that slide, because there was an increase in from silver to gold. Sorry, maybe two slides from silver to gold. But then I would expect that, going from silver to bronze, but going from silver to gold, is there, maybe talk a little bit more about these changes?
Yeah, maybe two, which is in certain states, the silver premiums as a result of silver loading, and we'll be getting to that a little bit later in the presentation for reasons. The silver premium is actually higher than the gold, and so in those states, there was actually buying, quote unquote, buying down where they're going to a cheaper plan. It just so happens that the gold plan is cheaper. And so in a lot of cases, just people are looking for lower net premiums. Unfortunately, one of the limitations of this kind of paid data is we weren't able to separate out subsidized from unsubsidized enrollees. So I can't answer that question. It's definitely something I think we'll try to get a handle on, especially over the course of as we're continuing to look at this data. Is just how much is that distribution changing post grace period, because that should give some indications as to what some of the different dynamics are between subsidized and unsubsidized.
Okay. And you said there'll be another updated analysis coming in a couple of months with some of these changes, so folks can look forward to that.
Yep.
Okay. There's a couple other questions, but I think those issues will be answered as we move forward, so we can keep on trucking.
All right, I think I'm next. So another timely update that we wanted to provide today was brief overview of the final 2027 Notice of Benefits and Payment Parameters. The final rule was announced on Friday. As a reminder, this is the annual rulemaking process for CMS to provide issuers, brokers, marketplaces, state regulators with updates to key ACA policies. It comes out every year. This year's cycle was a little later, or quite a bit later than the normal cycle. And kind of the upshot of that is that puts greater uncertainty on the overall process for issuers, regulators, and all involved stakeholders in terms of preparing for and getting ready for the 2027 plan year. Of course, these changes are happening in the broader context of enrollment and stability changes in the ACA markets. We just talked about that in great detail, some of the broader issues happening, but it's just one piece of a kind of broader trend of change in this market. And then lastly, this rule goes into effect on July 20th, 2026, but for specific provisions, many of the specific provisions are not effective until 27 or 28. And when you're trying to unpack and understand the implications of specific provisions, it's important to pay attention to their effective date. Next slide, please. Wanted to provide kind of a brief overview of the buckets of changes in this final rule, and then we'll get into some notable changes or clarifications. But broadly, we've organized the changes into the four buckets here on the screen. These changes impact eligibility, enrollment, and plan design policies. The first bucket being expanded availability of lower premium plans with higher out-of-pocket cost sharing, out-of-pocket costs. This is through policies such as the expanded availability of catastrophic plans for a broader group of consumers, as well as the duration of those plans. They can now be, available for multiple years, including up to a 10-year period. The increase of out-of-pocket caps on some plan types, including catastrophic and bronze plans, and for the first time in this market, the availability for states to allow plans that don't have a standard network of providers, known as non-network plans. So that's for the first group. The second bucket is enhanced accountability on stakeholders in this space, in this market, including brokers, issuers, broadly states. That's through new reporting and oversight on cost sharing reductions and silver loading. Michael will get into the implications of that in a minute. New opportunities for states to have network oversight around network adequacy and essential community provider compliance, as well as revised requirements around the defrayal of costs for state mandates that exceed essential health benefits. The third bucket is around program integrity, targeting concerns related to fraud, waste, and abuse. These are policies that are largely a reissuance from the marketplace integrity and affordability rule that was from last year that's currently held up in the courts, and that includes verification requirements around special enrollment periods, verification requirements for income around specific populations, including those who have income below 100% of federal poverty, or those who don't have any income data coming back from the IRS or other data sources. There's also a revised policy around failure to file and reconcile, the requirement that consumers who receive premium tax credits file and reconcile those on their taxes. And this policy changes the implications of not doing that for just 1 year, resulting in you losing the ability to receive tax credits until you correct that action. The last bucket is around codifying specific changes, eligibility and tax changes that were codified or created in the OB3, the One Big Beautiful Bill Act. This includes immigrant eligibility changes, including putting into rule the requirement that those subject to the 5-year bar from Medicaid, those who have been in the country for less than 5 years and are denied Medicaid eligibility, they no longer, starting this year, can go to the marketplace to receive financial assistance if they otherwise qualify. Other changes include the removal of excess premium tax credits, the removal of the cap on recoupment of premium tax credits in the tax filing process. So those are the big broad buckets of changes and some of the details underneath them. As I mentioned, we're going to focus on some notable changes from the proposed rule in the following slides. So moving to the next slide, I'll touch on some state exchange model and oversight highlights. The first being that in the proposed rule, there were a couple things around state-based exchange models that were not finalized, that were clawed back in the final rule. The first is the creation of the state-based exchange enhanced direct enrollment model. This would allow a state who wants to set up their own exchange the ability to forego having a centralized marketplace operation for consumers to go apply and enroll, allowing them to defer that to private web brokers and issuers. Related to that, the proposal to not require state exchanges to have a centralized consumer-facing website was not finalized as well. The rationale there in the final rule, is that the volume of comments was so significant that they were not able to be responsive to all of them at the time of finalizing this rule. CMS still supports these policies, but probably won't, and they may come back in future rules, including the 2028 NBPP. The next notable requirement is the State Exchange and Proper Payment Measurement Program. This is new oversight on state exchanges, specifically around the eligibility determinations for premium tax credits. This is a new audit oversight requirement that is currently in place for the federal exchange, but not state exchanges, and should replace some current audit requirements for the programmatic audit that state exchanges are currently subject to. And generally speaking, is a new oversight program that state exchanges will have to put time and attention and resources into complying with. The last thing to note is the failure to file and reconcile change that I noted on the previous slide. This will go into effect in 2028 for all exchanges. It will go into effect for 27 for states that are on the federal exchange, healthcare.gov, but state exchanges have the option to maintain a 2-year policy where they don't remove eligibility for subsidies for consumers who haven't filed for just 1 year. They can maintain the 2-year policy until 2028. So with that, I'm going to hand it to Michael, who's going to talk a little bit about other changes, including changes around silver loading.
Yeah, we think this is probably one of the more significant ones, less that it changed from the proposed rule, but A, that it didn't change, and then 2, some of the enforcement. A quick background on CSRs. As part of the ACA, low-income enrollees get certain cost-sharing protections. For the initial few years of this, the CMS paid for this additional kind of liability that issuers incurred as a result of providing more cost-sharing protections. Under the first Trump administration, these payments were halted, and so issuers increased their rates to account for the higher liabilities. In certain cases, states kind of mandated this in an attempt to protect consumers. As part of the NBPP, there's kind of 2 major reporting requirements that are kind of new. One is that they'd have to provide historical information on what the CSR payments would have been and aligning it with revenue. This involves using what's called the standard methodology, or issuers would have to re-adjudicate claims. In a few cases, they actually have to double adjudicate. This can be a very cumbersome, difficult process. Nonetheless, CMS thought it was important for program integrity purposes. The second is around projected 2027 data, or in effect, projecting out what their load, their silver load, basically the additional premiums that the silver is higher as a result of these unpaid CSRs. And CMS, again, is requesting or requiring that issuers include information in their actuarial memorandums as part of their form filings to ensure that the revenue that they're generating on their silver load is not materially in excess of what their liabilities would have been under CSRs. And this is to ensure, again, that premiums are not in excess of what, from CMS's perspective, they should be. Next slide. The two big differences is the compliance angle. What if issuers do not follow through on these requirements? One is that they, especially for the FFM, may not be certified as a QHP. They may not be able to offer coverage through the marketplace. And if states do not enforce the regulation as CMS puts forth, they could lose their effective rate review status, or they could lose the ability for the state themselves to review rates. These are pretty drastic potential penalties. And as a result, it certainly brought the attention for a lot of issuers and states on this issue on how to handle it, how to fill out their forms, how to conduct rate review. Next slide. And so this has a few different implications. One is this is a higher burden on issuers for reporting. CMS itself said that the burden would be in the hundreds of millions of dollars for this kind of reporting. Two is that issuers and states may change how silver loads are done. This has implications, one from a rate review perspective, but also as silver premiums, if they're a little bit lower, premium tax credits could be lower too, and so you could have higher net premiums on consumers. And not to steal Liz's thunder, this is kind of an open issue as there is potential congressional activity on CSRs, and so the extent to which those do or do not happen, there is the potential for further regulatory action in 2028. Next slide. Beyond this kind of CSR things, just three things to flag. One is around the bronze MOOP change, which is that issuers will be allowed to have expanded flexibility in the form of they can offer bronze plans in certain circumstances that exceed the annual maximum out-of-pocket expense. They can do it up to 130% of the MOOP. This was also provided to catastrophic plans, although this isn't until 2028. Bronze plans would be starting in 2027. I'm not going to get into all of the catastrophic changes, but probably the most significant from a pricing perspective is that they codified the eligibility expansion, which is basically anyone without APTCs or CSRs would be eligible for catastrophic plans. Finally, non-network plans that have probably quite literally don't have a network would be allowed on SBMs and SBMFP starting in 2027, and they'd be allowed on the FFM starting in 2028. So I think then I'm going to pass it back to Zach, and then we'll keep rolling.
Thanks, Michael. And I'll be quick on these last highlights. Just a couple other things to note. The FFM and the federal exchange and state exchange user fees changed from the proposed to the final. They were proposed at 2.5% of premiums and 2.0% of premiums, respectively. They're in the final rule, they're 1.9 and 1.5. Rationale cited was that premiums increased from 25 to 26 more than CMS anticipated in their original estimates, and therefore they were able to lower those fees. Similarly, the risk adjustment user fee was scaled back a little bit from 20 cents PMPM to 18 cents. And lastly, the state mandate defrayal, the requirement that states pay for any state mandates that are above and beyond essential health benefits. The revision to that was originally planned for 2027, but has been deferred to an effective date in 2028. And so with that, I'm going to hand it over to our colleague Liz, who's going to talk about who's going to give a federal outlook talk. Thanks, Liz.
Thanks. And, we'll zoom out for a minute here and look at what are some of the federal policy activities or landscape that's actually informing, some of the decision making at HHS, but also what could be informing what could happen this year and even into next year. And so first, just to kind of ground us in where we are in like a legislative time frame, we are in a midterm election year. We are heading into summer. Congress takes a month off in August. So the amount of time to do anything, pass any legislation is actually really tight for the rest of this year. So if anything were to happen, your two options essentially are appropriations, which is the end of September, really pushing you up against open enrollment, or frankly, what we would consider lame duck, which would probably be something that would pass right before Christmas. So we're not really hearing a lot of chatter on the Hill right now about open enrollment or ACA market stability or the enhanced subsidies anymore. It doesn't mean there necessarily won't be anything, but I think what we have seen is that members of Congress tend to react to the, news releases and press releases that they're seeing, home in their states. And so to some extent, they kind of need to see rates begin to be filed for the next year before they can kind of feel like they need to do something. When it comes to the enhanced ACA subsidies, I think part of the challenge is even if there was kind of a political will to take it on, there's still not consensus amongst a number of members on, do you add additional protections so that the dollars don't go to health plans that may offer abortions? That was a sticking point. There's also a sticking point among Republicans as to whether or not any portion of those enhanced subsidies should go straight to consumers. So I don't think we are any closer on any type of bipartisan deal to kind of reinstate the enhanced subsidies as we were when it kind of last broke down. And I don't really see us moving forward unless, rates start to go up again when they're filed. And certain members that are in tough races start to put pressure on their leadership to do something. So instead, we kind of had this focus on the enhanced ACA subsidies in Washington for the last, year and a half. It seemed like if you were talking, outside of SSIO, if you were talking on the Hill or within HHS or the White House, and we're talking about the ACA or marketplace, everyone really was focused on those enhanced subsidies. What's happened now, though, is it's kind of like everyone has transitioned to a larger affordability conversation. And so, on the Democratic side, we've seen a number of policy proposals coming out, and particularly amongst, Senate Democrats. They've really decided that they want healthcare affordability to be a strong part of their election and midterm strategy, and that they aren't comfortable just kind of going against Republicans for not extending the enhanced subsidies or for some of their Medicaid changes. They really want to put on the table what they would do if they were in the majority. So you still see a little bit of focus on the enhanced subsidies. So that's kind of one policy option. The other is the ranking member of the Finance Committee, Ron Wyden, who's been, a major player in coverage legislation, has announced that he is putting together with at least 12 other Senate Democrats a proposal to lower healthcare costs and improve health coverage. The idea would be that they would spend this year working on the bill, and it would be introduced in 2027. So they're not even looking at trying to make any impact for this year. I will say the Senate Finance Committee Democratic staff are meeting with stakeholders now. So I encourage folks to go look at their website and if you have thoughts to share them with them. We're also seeing other outside organizations come up with policy proposals as well. One is a concept of Medicare by choice. So instead of kind of Medicare for all, we're looking at more of having Medicare as an option that people can purchase kind of on a marketplace. The other is the Center for American Progress. They came out with a larger proposal, again, looking at tying premiums to underlying medical cost, strengthening rate review, tightening medical loss ratio, and really looking at deductibles and kind of consumer costs. So again, a number of bigger picture reform policies that a number of Democratic stakeholders are setting out to be part of the both midterm conversation, but if they take over power in the House and or Senate, this is giving us a sense of what some of those policies will look like. We can go to the next slide as well. And then on the Republican side, I would say, again, we've really seen this focus on affordability in general versus just kind of the ACA and marketplace. We're seeing a lot of Republicans talking more about defined contribution models versus a defined benefit. So a lot of talk about ICRAs. It's really funny to me. I feel like ICRA has been like the new cool name you keep throwing around. I'm not sure people thoroughly understand how to make that workable at this point, but it keeps getting thrown around as a way that could potentially both strengthen the individual market and also help on the employer side. As Michael talked about, a lot of Republicans in House and Senate are very focused on increasing access to catastrophic coverage. So essentially codifying what is in the final rule that would allow more individuals over 30 to have catastrophic coverage, and funding cost sharing reduction subsidies. That's a kind of a big part of, I think, where Republicans are. Then you have a bunch of other plans that are out there that I kind of put in the kind of talking point space. You have the Great Healthcare Plan from the president. The Republican Study Committee on the House side put out a framework. Again, I would say these are things like expanding HSAs, ICRA, maybe doing something on medical loss ratio, but really not a lot of kind of substantive changes in the ACA space. One thing that's been interesting is we've seen these affordability hearings, and we've started to see Republicans focus on some issues that they haven't focused on before. So, looking at healthcare costs, drivers, price transparency, and market competition. And so, those affordability hearings, I think, are starting to bring out issues for Republicans that they may be interested again in doing something on this next year. And then finally, Senator Cassidy, who is the current help committee chairman, unfortunately for him, lost his his primary this past weekend, and so will be leaving the Senate at the end of the year. But he has an agenda that he is still hoping that folks will coalesce around this year, which would be moving some subsidies to kind of direct patient funding for out-of-pocket costs, doing some things on price transparency, and then doing some more things on healthy foods. So I think it's not very likely that much of that gets enacted, but I still think that that will be some of the policies that he'll be pushing. And then finally, we can go to the last slide. Is there ever a sign of agreement between all of these folks? So as I mentioned, I actually think in the affordability hearings, we started to hear some themes come out where particularly, like there were some Republican members that I was a little surprised at some of their talking points. So prior authorization became a real issue that a number of members talked about. Medical loss ratio, I thought was really interesting during, the drafting and debating of the Affordable Care Act. I think congressional Republicans took more of a stance of, they didn't want to have either a strong MLR set in statute or the penalties around MLR, were concerning. But interestingly enough, you heard a lot of Republican members really kind of going after insurance CEOs to really show where the dollars were going, which I thought was interesting. Price transparency, which we've seen for a long time. And then finally, the other big one is consolidation. Again, this is one where if you looked at hearings for the last couple of years, you wouldn't have seen as many Republicans talk about consolidation as a driver of healthcare costs. And all of a sudden, I think you are seeing congressional Republicans more willing to look at some of the business decision makings within healthcare, like consolidation, to try to get costs down. So whether it's some small policies at the end of this year or more areas of agreement, potentially next year if we have a mixed Congress, here are at least some areas where I think there, may be some bipartisan support. At least at this point, they're all acknowledging them as issues. Whether or not they can come up with, consensus around solutions, I think remains to be seen. But at least, again, it was encouraging to at least see some diagnosing of the problem, kind of from both sides. So Jen, I'll get back to you and happy to answer any questions and join in the dialogue.
Excellent. Well, I will take the privilege of being the moderator to ask the first question that I have, which is if you could talk a little bit more about Senator Cassidy and the kind of changing of the guard there in the Help Committee. I'm curious. I mean, you sort of alluded to what he might try to achieve this year. Are there things you think he might try to push for that he wouldn't have otherwise, let's just say. And then also kind of like what happens next if Republicans retain the Senate, who would succeed him as chair, and what does that look like in terms of change?
Yeah, it's interesting because I think Dr. Cassidy has been a unique player in the Republican conference as a doctor and as somebody who really likes health policy. He generally leads from the perspective of like, we should have a plan of our own, we should have an opinion. And so I think, without him, There's not as many Republican senators right now that I think are in that space when we're talking about kind of ACA policy. So I think he will try to get some things done before he leaves. I don't know though that, the rest of the members are necessarily interested in addressing some of these issues right now. So I think it's going to be hard for him to get much excitement for doing something in this space. Looking to the future, Rand Paul is technically next in line if Republicans were to keep the Senate to be the chairman of the Health Committee. He also is over at Homeland Security and Government Affairs. They have subpoena power, so it's also likely that he stays over there. And then next in line would be Roger Marshall, who's been more active, I would say, on kind of in the FDA or kind of life sciences space. So I don't think we have a strong sense of kind of where he would be on coverage. And then, of course, if this Senate it turns to Democrats, I think the expectation is still that we would have Bernie Sanders as chairman of the Health Committee. So I think finance, where the subsidy pieces live, will continue to be pretty stable with Wyden and Crapo. But yeah, I do think it changes the dynamics. And I think the Republican senators that advocated for doing something around the ACA subsidies have subsequently lost their primaries or are in tough races. And so their political capital is pretty limited. I would say the one person that probably still has some capital that they could use in this space is probably Susan Collins.
Interesting. There's two questions on the Medicare by choice idea that you floated. One just sort of saying probability, but also like how would that work? How is that different from the ACA exchange if you're allowing people to buy directly? What does that look like?
Yeah, so I mean, essentially, under the ACA exchange now, it's all private insurance. And so people can get federal subsidies, but the payer is still a private payer. So in a Medicare by choice environment, it would be traditional Medicare. Potentially, or it also could be like a Medicare Advantage where it's kind of Medicare, but then, administered from, a private health insurance plan. So you'd have Medicare benefits, kind of Medicare reimbursement for providers. And the idea would be that, you could see it's kind of crafted a couple of different ways. You could basically, have a certain age group that could potentially kind of enroll in Medicare. So maybe you say 60 and above, you could enroll in Medicare. But again, that's still a federal payer. So it would be the first time you really had a sole federal payer as an option on the exchange.
Got it. And then just a question, are association plans still in the ether?
Yeah, still in the mix. I think one of the things you can see in the notice of benefit and payment parameter rules is, looking at things like, plans that are outside of kind of ACA plans. And so I still think we'll see some push on association health plans, short-term limited duration plans. I think those will continue to see some push. I just don't think we saw a huge impact in them. And so I don't know if the juice is worth the squeeze, but they are still very interested in kind of that space. I also just saw the question about consolidation. Really, we're talking about mergers of hospital and insurance companies and kind of monopolies. And so that kind of driving costs in kind of individual healthcare sector players, at least claiming that they don't have as much purchasing power as they used to drive prices down. And so traditionally, I think Republicans have been less likely to want to legislate in business, decision making. But I think that is changing. And so it's really interesting to see them now taking more of an active role in how some of those business mergers may impact costs and price.
So both horizontal and vertical, to be clear.
Yeah.
Yeah. Okay. Great. So there's a question about ghost members, which is, I think, been, floated in regard to program integrity concerns around ACA exchanges. So the question is sort of a specific, is there a case where somebody in a 0% premium plan from last year migrated to 0% premium plan? Sorry, I'm saying $0 premium plan this year. Basically, have any of these changes dealt with some of the program integrity, perhaps concerns, and address this ghost member problem? Or can you kind of speak to your sense of that?
I'm happy to start. I think the expiration of the subsidies has created a environment where there's much less opportunity to enroll in $0 premiums. And so the year over year picture of that, although Michael mentioned circumstances where it's still possible where people can buy down or based on their eligibility and their plan selection, they can move year over year into a $0 plan. I think the expiration of the subsidies themselves have made the universe of eligibles who can access those types of plans much smaller. So in that sense, the ability to game that is for qualified populations is smaller. I also think CMS, who has been very concentrated on rooting out bad actors and fraudulent brokers through healthcare.gov, have taken a lot of steps to address that. They certainly are seeing the need to make it harder, administratively more difficult for consumers to verify and stay covered through the rule, as well as through changes that came down through OB3. So there's certainly more movement on that ahead of us. I think has it been fully addressed is a kind of subjective question. I think because there's another question of how rampant was it to begin with, and there's different opinions on that particular question as well. So I would say the feds have taken several steps to address those concerns. The affordability of coverage is less so today, and therefore harder to access those types of plans. And there are more program integrity initiatives ahead of us as well.
Thank you. Probably have time for one more question, and this is maybe a big one. Well, it's either really big or really small. The issue of non-network plans. What do we mean by that? What interest might there be? The question is, are any states and issuers interested in offering these plans, and how quickly? Can you talk maybe about what that might portend for choice for people?
Sure, I can start and appreciate others. Yeah, so non-network plans, sometimes they're called reference plans, but basically the plan would give the enrollee basically a certain amount of money for a service, and it's up to them to kind of shop around to different providers, and they kind of have either the cost of the difference or get to keep it. So if you went to get a knee replacement, the issuer offers X amount of dollars, and if the provider charges X plus $1,000, the consumer would owe that $1,000. And so the idea is that incentivizes consumers to shop around for a cheaper or better priced service at a provider. We haven't heard really any information on non-networks currently for 2027. In the past, like it's popped up in a few locations, like for example, Sidecar in Ohio. So I think it's still evolving. The fact that it's not available nationwide, right? Healthcare.gov, it won't kick in until 2028 might also mean that it has kind of limited, impacted this particular year. I don't know, Zach, Liz, anything else?
Agree. I think it's very late for us to see a lot of activity in 2027 is my general sense.
Yeah. So maybe final lightning round. In totality, do we think managed care margins are higher, lower, or in line with their expectations in 2026? Anybody want to offer a
lightning round?
I mean, is that just a yes, no answer, higher, lower? It's not that simple.
I think enrollment is landing generally where expectations were assumed to be. So my guess would be in line.
Okay. Well, thank you for joining us today. You will get the recording. Please share it if you would like to talk further with any of these experts or anybody else on all of these questions. We'd be very happy to make that happen. So let us know. And we appreciate everybody's time today. Thank you, all three of you, for your insight, as always. Thanks so much.